like, what am I doing? What's the next thing?
Yeah.
And I realized that if I buy another duplex or another fourplex, I'm going to shoot myself.
You're listening to the Just Start Real Estate Podcast. If you're serious about your real estate investing business and need real answers, you are in the right place. And now, your host, Mike Simmons.
Hey, thanks for joining me today on the show. I appreciate you being here. Got another good one for you. I'm excited about it. I can't wait to bring it to you guys. I've got a return guest, and I do that from time to time. But this guy, he's from episode 4. Like, I interviewed him so early on, and I went back and listened to that first interview, and I welcome you to do that as well. But I went back and listened to it, and other than it being super cringeworthy from my perspective and just the way that I ran the interview and how new I was, and it was kind of tough. But Ben is an interesting guy, and I knew that obviously before I rebooked him, and I went back and listened, and I forgot exactly how fun and interesting this guy is. His name is Ben Leybovich. He was not so much nowadays, but back in the day, he was a very regular contributor to BiggerPockets, and he was very, very active there. And his evolution of what he's doing has really been pretty amazing. And we talk about that in this episode. He went from being like a single family guy to like a duplex, triplex, fourplex kind of an investor. And now he's into large syndications and doing some really, really cool stuff. And this show is definitely caters to maybe a little bit more sophisticated of an investor, which is totally great. If you're a newer investor and you haven't really gotten that much experience yet, this will give you a good snapshot into something that you may be interested in down the road. And if you're already to that point, this is a nice high-level discussion about some more advanced type investing techniques and things. So I'm excited to bring it to you. One quick disclaimer, I have never promised to not curse on this show or anything like that. We just generally don't. For whatever reason. But this show does have a couple of choice words, a couple 4-letter words. So if that is something that you're concerned about, then just be warned. It's there. And it's not that bad, honestly, a couple times, but no big deal. We're mostly adults here. But if you do have children listening, I'm just giving you that forewarning. So, but that being said, this was a really, really fun interview and very, very packed with great information. And like I said, a little bit more of a sophisticated discussion as it relates to syndications and buying larger multifamilies and things like that. And Ben is the guy. He is an author, very funny in the interview. We were mentioning one of his books. He couldn't remember the name of it. I had to look it up and tell him what it was. But it just goes to show he's not here to promote anything. He's here because he likes to give back and he likes to be a resource for people. So he is an author, though, of more than one book. Business owner, real estate investor. He also has his own podcast that we talk about a little bit. That podcast is called the Multifamily Syndication Unscripted Podcast. So you can check him out there. Like I said, featured writer on BiggerPockets Blog for years, professionally trained violinist. But was diagnosed with multiple sclerosis back in college. And that kind of ended that dream. He wanted to be a violinist. Like that was his goal in life. And he had to pivot. And he is now the managing partner of WhiteHaven Capital, a private equity investment firm specializing in the acquisition and repositioning of underperforming multifamily assets in growth markets. In the past 7 years, he's managed to assemble $1.5 million in personal real estate portfolio with 28 doors that he personally owns, generating over $165K in annual revenue with an annual cash flow of about $40K. But that's in addition to WhiteHaven Capital, which he is the managing partner of, and they're doing some big syndications, and that's really where we focus most of the time in this show. So I don't want to make you wait any longer, guys. Buckle up, get ready for the very honest and very, very knowledgeable Ben Leybovich. Hey, Ben, welcome back to the show, man. It's been a long, probably way too long, but it's been a long time. I loved having you on originally, so thanks for doing this again. I appreciate it.
It's my pleasure. Absolutely. I still see your show showing up across my whatever it is, social media universe or whatever. And I thought, well, it's got to be more than 5 years now. We should get
Yeah, I think it was late 13, maybe early 2014 when we first connected and you were on. So we're pushing 7 years here probably. So I'm pretty sure that there's been some changes to what you're up to. And there's definitely been changes to what I'm up to. But everyone kind of in my audience sort of knows what I'm up to. But I'm interested in hearing the update on you. I know what you were doing back then. I went back and listened to most of that old interview just to sort of get my head back into what you were up to back then. But I know you're into new stuff now, some exciting stuff. And, this show, we have our share of beginner investors for sure. But I know for a fact, just from speaking to folks that listen and people who reach out to me, there's enough people who listen that are into like next level stuff. They're not just trying to figure out how to get the ball rolling, but they've been investing for a while and they want to do bigger and better things, and they want to get into multifamily and syndicate, all that stuff that you're into. So I'm excited to feed that portion of my audience that's really hungry for these advanced kind of next level stuff that happens maybe not at the beginning, but something people work up to. So I'm excited about that. But let's for people who didn't hear the first episode 7 years ago, in all fairness, I'm not naive enough to think everyone goes back and listens to all my shows. Why don't we give them the maybe the Clip Note version of who you are, why we're talking, how you got started in this whole thing, and what shaped your life to this point?
Sure. Well, I'm not bashful at all. So I'm going to tell you that if they don't go back and listen to all your shows, what the hell is wrong with them?
Exactly.
What do they got better to do than going back and listening to all your shows, right? That's
right.
Number one.
Perfect.
Number two, if they don't know who I am, what the hell is wrong with them? How do you be in real estate, listening to podcasts and yours and BiggerPockets and everything, and not know who Ben Leybovich is? So like this is me not being too bashful, because some things might never change.
This is what I liked about you back then, Ben. It's what I like about you now. I love your no BS, basically, approach to things. So I love it, man. I love it. It's good. You're right. What are you doing? What are you listening to if you don't know who Ben is? And what in the heck have you been doing if you don't know anything about what he did on the first show?
What rock have you been hiding under for the last 10 years? Yeah, it's horrible. It's horrible. Ask me if I care. I'm rich. I got a lot of real estate. What do I care?
Exactly. Now,
if you like it, not like it, whatever.
Exactly. And now that we've gotten through the portion of our show where I shame my listeners by not knowing not knowing what's going on.
I'm just getting started, dude. I'm just getting started. This is going to be raw. You just don't even know yet.
All right. Perfect.
In 2013 or 14, that was the time when I grew my portfolio in Ohio, and I got to a place, I think you caught me right in that transition space where I realized I could continue doing what I'm doing and be somewhat successful at it.
Yep.
Achieve financial independence, achieve, enough passive cash flow, my family would be okay. In a man's life, there comes a point, and I think if you look at successful people, this happens several times. Let's call it an inflection point, where you look at yourself in the mirror and you realize that the cup that was you yesterday, that's over full now. There's nothing more that's going in that cup, and now it's spilling over. Yeah. And you may not know exactly what you are today, but you do know that you are not the same thing you were yesterday. Yep. And so that's the space I was in 2013, 2014, 2015. I had a portfolio of property. I paid sufficiently enough off private mortgages and what have you. I had some cash flow. I felt a certain amount of freedom, not a lot, but a certain amount of freedom, that which I think all of us strive for in the beginning. And I arrived to that point, and it literally didn't take any more than 3 or 4 months of me being at that point when I realized if this is all there is to life, I don't even know what to do with that, because this is, first of all, boring as all hell. Second of all, I'm not evolving. I'm not developing. I'm not getting smarter, better. I already know this stuff. Yeah. Like, what's next? What do I do now, right? So that's when we recorded the first show. That was the thing. And I did take a couple of years off. Basically, I created that CFFU, Cash Flow University, Cash Flow Freedom University, the course that I used to have. I still actually have, but I haven't seen that website in probably 5 years. But people still buy the course and it's still viable for those people who are starting out in the beginning. But I took about a year to create that because I looked at it and I said, listen, maybe I don't know what's tomorrow for me, but I do know that there's a lot of people looking for my today.
Yeah. Yep.
You know, the what I have today, I may feel like, you know, the cup's too small, like the closet is too tight. You know, I may need to get out of that. But for a lot of people, just even arriving to this point is what the doctor ordered.
Yep.
So how can I help that process? So that's where I created CFFU, Just Ask Ben Why, and that whole thing.
Yep.
But for myself personally, so that was done. And then, you know, I had cash flow from property. I had cash flow from courses selling, and they're cheap courses, $200, $300. But still, there was a period of time I was selling like 50 a month. So there was significant cash flow coming from that, significant cash flow coming from the portfolio. And, you know, I took a couple of years off to figure out what to do. You know, like, what am I doing? What's the next thing?
Yeah.
And I realized that if I buy another duplex or another fourplex, I'm going to shoot myself.
Yeah.
That train has sailed.
Yeah.
I'm mixing mine, but you see what I'm saying.
Like, I know trains don't sail, Ben, but I hear you. I get you.
Completely sailed. Okay, I can't go there anymore. I can't do that. That's not me. I can't look at myself in the mirror and pretend like it's okay. Okay.
Yeah.
So I needed to raise capital. I needed to attract equity. I needed to buy big deals, syndicate big deals. But I realized that I didn't want to do that in Midwest. I understood Midwest very well. And one thing Midwest was not, is not, and will never be is a growth market. And so I realized I started looking and we traveled. I took the family, Atlanta, Georgia, the Research Triangle in the Carolinas, Denver, Colorado, Utah, Arizona, Phoenix. Yep. And it's just like every place I go, I measure it in Phoenix. Like the weather is great. The charter school education is great for the kids. The real estate is great. The weather is great. The palm trees, the blue skies, the low property taxes, the low insurance costs, all of that. You triangulate all of that. And it's like, it's in my mind, for me, for my lifestyle, for my family, it was like, there's nothing that compares. And so we ended up moving to Phoenix about 4 years ago now. So that would have been somewhere in the 15, 16 range.
Okay.
So maybe about 3 years after you and I talked first and recorded that podcast. And so since then, it took me a while to kind of land on my feet, figure out what to do. The first thing I did was I bought what I call a luxury house hack, because I'm a real estate investor, and it pains me to all hell, no matter how much money I'm making, to not be making money on real estate. Mm-hmm. And so I bought a house with an attached mother-in-law suite. They call them casita over here in the Southwest.
Yeah.
And I rented it out on Airbnb. That paid my mortgage. And I just kind of, okay, now what? Right. And so the intention was always to syndicate. I just, that was the first step. I wrote a book about it. I put it on Amazon, all of that. That's about 3 years back. It's called, I can't remember what it's called. Look up my name. And
Ben, you just not just to say you don't know what your book's called.
I have no idea. I did it.
Let me ask you a question. How long did it take you to write that book? I just wrote a book. It came out in June of last year. I know how hard it was and how much time. How long did it take you to write the book?
It took me about 3 months.
Okay.
All in. It wasn't difficult. First of all, I wrote it very quickly because I knew exactly what to say.
Yeah.
Secondly, it was a one subject book. It wasn't about real estate investing. It's what is a house hack? Why is it good? And for whom is it good? And what makes it good? So because the subject matter is so narrow, now my approach was, what are the 15 questions that people are likely to ask?
Yep.
That became my chapters.
Yep.
So I answered each one of those 15 questions, and that became a book.
Well, let me just say, first of all, because I have notes on this, it's called House Hacking, the only real estate investment strategy you need to build wealth, live for free or almost free, and make money through home ownership. That's your plug for you. You can record that and put it out if you want. But that's the name of the book, guys, if you're wondering. And I think that's
sells every month. I get money from Amazon every month. It's same as CFFU. This morning, I got an email that somebody purchased the course for $199.
Yeah.
I haven't called them yet. I always call everybody that calls just to purchase, just thank them because it's a nice thing to do.
Yeah.
But I'm so jaded. Like nowadays, I don't even roll out of bed unless it's $250,000. Like, seriously, like, I'm glad I recognized that there's more to life than duplexes, fourplexes, and all the rest of that stuff. Nothing wrong with it. But for me, it's all about education. It's all about feeling that the intellectual worth is taking the next step and the next step and the next step, because the money always follows. Yeah. It's about the knowledge. And so that's where I hit a ceiling. I hit that wall, and it was just like, it bruised me. And then I was just like, oh, okay, what happened? And I had no idea. It took me like 3-4 years to figure it out.
Okay, that's what I was going to ask you. You went from buying the duplex and the fourplex, and now you're into syndications. How did you get that education? How did you even know what to do? Buying a duplex does not necessarily fully prepare you for syndication and these large multifamilies. How did you? And I know, just all kidding aside, from what I knew about you back then and what I know about you now, you're not someone who jumps into things haphazardly and just, doesn't have a clue what they're doing and they just figure it out. Like, you're an educated person. You like to be informed. And you strike me as someone who would understand the realm he's about to walk into. And maybe I'm wrong, but how did you prepare yourself adequately in your mind to be ready to do that?
So I've never read a book on syndication, and I've never read a course on syndication. Not saying either is bad. I'm just saying I didn't. I have always been blessed with teachers and mentors. I don't mean paid teachers and mentors. I just mean people in my life, in my space, in my universe that will, crack the door, so to speak. Not necessarily give me all the answers, but shine the light on the important stuff to point me in the right direction to figure things out. Yeah. For the rest of it. And so this was true before I bought my first duplex. And this was also true before I bought my first 100-unit community. Mind you, Phoenix is the hottest market in the country. I just purchased a property at 3.5 cap. And I'm going to make $10 million on it for the investors and myself and everybody involved. And there's no question about it. We're going to do it just because Phoenix is the most desirable market for institutional investment capital to be in. So it's very pricey. Mm-hmm. But so not only do you have to know how to syndicate a building, you have to know how to do it in a way that makes money while you're buying at 3.5 cap. Who the fuck pays 3.5 cap for an apartment community? And how the hell do you make money at that? And yet this is where the biggest money is made. So the education is staggering. Yeah. And I've never created any educational content on it. And I've never created any courses or anything because I don't believe it's possible. Because there are so many, it's so dynamic that I think I'd be doing it a disservice. And I don't know that. In fact, I've declined people offering $50,000 for me to work with them. I just won't do it. Yeah.
Yeah. So let's answer that question. You buy something at a 3.5 cap. Again, I know that probably the answer is there's a million ways to do it, but is this all about, I know it's underperforming assets. Obviously it's underperforming. If it was optimally performing, you probably wouldn't be as interested, but it's underperforming. What are some of the reasons that they're underperforming? What are some of the value adds that you can go in and do that makes them worth more than what you paid for it?
Well, listen, if somebody paid a 6 cap 5 years ago, and they're sitting in the market today, do you think they need to push rents?
If the market has gone up, you said?
Yeah.
Do they need to? No, probably not.
No. And so that's the most sophisticated investment strategy, is when you have the balls to step in at the bottom of the cycle and play the cap rate compression game, knowing that the market is going to take you out and you don't have to do any of the value add.
Yeah.
So I'm purchasing a property where the average rent is $850. A little bit cleaned up. The loss to lease is probably $200. So the rents could be $1,050 without doing any major renovations. But if I were to renovate it, there's another $200. So there you have it, a property that's renting on the average for $850, that's going to be renting for $1,250 on the average. So I'm maybe buying it at 3.5 cap. Upon my basis, I'm going to be at 6.5 or 7 cap 2 years from now, after having completed the repositioning, and the market is still at 4.5 to 5, and that's where I make $10 million.
Right. So how do you, and I think I know the answer, but I'm trying to make sure that we're not leaving a lot of gaps for people. How do you get a multifamily full of people paying $850 up to $1,250, or do you?
You don't.
Okay.
You are repositioning the tenant base. This is the fallacy of multifamily. It's become, catchphrases, value add, repositioning. All of that stuff just became cheap, like a hooker. Everybody who's anybody's talking about that stuff. If you take this is just common sense, and this is what comes with buying a duplex, which is why it's a great idea to start with a duplex. Yeah. If you buy a duplex and you have a tenant in there paying $850, there's a reason they're paying that, because they can't afford anymore. Okay, maybe you can paint the toilet for them and charge them $950, and they will stretch like hell to try to be there because you've painted it. And now it's not a pig, it's a lipstick covered pig, but they will pay an extra $100, but it'll take everything they've got because they can't really afford it. So they will stretch for it, but that's all you're doing. Now, if you take that property, you got it. You put new cabinets in, granite countertops, stainless steel appliances. Yeah, it's still not Class A. It's still not new construction. Yeah. But are you likely to get a different kind of profile of a tenant?
Yeah.
Are you likely to get an Class A within its competitive set in that 3-mile radius? Are you likely to get that? Yes, you are. And that person is going to be able to pay $1,150. They still can't afford $1,800 in the new construction,
right?
But they can afford to pay $1,150. So the trick is, one kind of value add is lipstick on the pig. And what that does is it stretches the existing tenant profile, which is not a good idea. And COVID has shown you this. Vice versa, if you are repositioning the asset, and by doing so, you are repositioning the tenant base profile that's attracted to that asset, that's a more sustainable model.
Yeah.
So likely most people who are there today won't be there tomorrow.
How does that work? Is that a Band-Aid, rip the Band-Aid off kind of an endeavor? Or is that a, little by little, we sort of transition the tenants into a different tenant because we're updating as we go? Do you wait for leases to run out? Do you
we have to wait. You have to legally, you can't, so, I mean, if you take a market like Phoenix and you just take 95% stabilized occupancy, which seems to be normal in most cases, out of 100 units, you're going to get 5 units a month. Well, if you get 5 units a month, that's 60 units that you're going to go through and renovate in the first year and catch the rest of them in the second year.
Yeah.
So without having to force anybody out, just general attrition, people moving on, people being evicted, skips, a few non-renewals, a few non-renewals on our end of month-to-month leases, things like that. You know, you're going to get your 5, 7, 10 units a month.
How does it affect? Does it ever end up? And maybe this is good. Maybe you kind of don't mind if this happens. But during that first year, when the tenants start talking and realize, well, when your lease is up, they're going to raise it from $800 to $1,100. And then people say, well, I'm just going to stop paying. I'm just going to get out of here, whatever. Like people start just leaving when they see that, they start reading the tea leaves. Does that happen? And if it does happen, do you even care? Because it seems like it's solving a problem.
Yeah, I don't care.
Yeah. Okay.
What we do is a quasi-development project. And that goes back to answering, how do you buy a 3.5 cap and make money? You know, 2 years from now, when it's at 7 cap, I can cash flow it all day long. And if we want to stay in that deal and cash flow it, great. We'll stay in the deal and cash flow.
Yeah.
The only difference is now, because I've taken the income from $80,000 to $125,000, $145,000, now it's a completely different asset. So capitalizing it at whatever the going market cap rate is gives us millions and millions and millions of value. Yeah. So it also provides us with a nice exit. Yep. So the sophistication of the strategy is it's a multi-pronged strategy, right? It's both a long-term hold and a flip, but it's primarily a flip because that's what requires us to increase the operating income.
Yep.
And that produces the higher valuation. And that higher valuation gives us an opportunity to refinance and cash out, to sell the property, you know, and still stay in there and cash flow, whatever you want. The difference, the distinction here is that you could go to a market, Indianapolis, and you just pay 6.5 cap. Mm-hmm. You can do that.
Yeah.
But in a market like that, nobody's going to let you raise rents $300 and $400 because there's no population growth to warrant that.
Yeah.
Okay. So that means you are trading the market. You can't do the kind of quasi redevelopment project. You know, it's almost like doing development, but it's a little safer because you have revenue to start with.
Yeah. Yeah.
Right. That's essentially what we do.
Yeah.
So I mean, in reality, to give you an example, we purchased the property for a bit under $11 million, with revenue of about $80,000. And when we sold it, it was 70% of the units were renovated when we sold it. And the revenue then was about 120, 125, with 70% of the units renovated.
Okay.
But we sold it for $18 million in like 20 months, 21 months, right? So that's kind of that's it. That's the flip.
Yeah.
You're in at 11. You've spent 2. You're out at 18.
Yeah. Is that the plan for most of them, to flip them, sell them at the end of the day, or to hold on to them?
That's an interesting conversation because really my job as a sponsor is financial engineering. So literally, you know, not in the first year because we have to create some kind of product before we can look at the exit. But when you get into months 13, 14, 15, 16, really my job and Sam's job, my partner, Sam Grooms, we just sit there and we look at the marketplace and we'll look at the asset and we ask the question, who can we pair this with? What kind of buyer profile, buyer avatar, so to speak, who would be interested in this? And every month we go through this exercise. And how do we position this property, financially speaking, to be interested to a buyer profile that we like? So the business model, we underwrite everything presuming we have to stay in for 10 years. But we're happy to get out in a year and a half if the right opportunity presents itself. Okay. So it's not at all a set it and forget it kind of business plan. Yeah. It's a very dynamic, very active business plan.
Okay, before we go too far, Ben, I'm writing notes like crazy, by the way. I know you can see me in the video looking down. I'm trying to take notes so I don't forget. I want to go back real quick in case anyone missed the lesson, because I think this is important. And I honestly, I don't know if I've had anybody say this on the show before. It's not an incredibly difficult concept to understand. I just think it's something that's a little different from what a lot of people will tell you. And that is, in a nutshell, and jump in if I'm wrong, Ben, if I'm misquoting you or misrepresenting. But what you're essentially saying in your world, in your life, and in your opinion, it's better to not go in and do quick surface improvements to a property and raise the rent a little bit, knowing that you're pushing the people who are there out of their comfort zone and their ability to comfortably pay that rent. It's better to go in and do more of a gut job, create a much, much better product and bring in a renter who's at the new price point, that's their comfort level and they're not stretching. That's just what they can afford to pay and that's okay for them. Am I saying that correctly?
Yes, and that's only a small piece of the puzzle because really most people think it's safer to spend less money because the less you spend, the less you can lose.
Yeah.
But if you spend less money and 10 other people spend less money, then when there's a downturn, you are racing everybody to the bottom and you have exactly the same shit that everybody else has. There's no daylight between the product you're offering to the marketplace and the product everybody else is offering to the marketplace.
Yeah.
So really this idea of doing more, not less, came about as a safety trigger. We said, okay, we don't have a crystal ball. We know how to be aggressive, but the most important thing is how do we be safe?
Yeah.
And quality is always king in a downturn because everybody starts looking, Class A people start discounting their rents because, they've overbuilt or whatever. Then Class B people look at that and say, well, crap, I can afford Class A. I'm going to go and pay for Class A. Then Class B starts discounting concessions. All of a sudden, Class C look around and say, look, I can afford Class B. And so on and so forth.
Yeah.
And so what we've created is a product that even Class B can't compete with because Class B is 2,000 construction with Formica countertops and black appliances. And for the owner at their basis to go out and spend the money to do the kind of updates, so it's a safety play. Yeah, is what I'm driving at. Gotcha. Right. So that was the basis for it. Now, can you do it on a small scale? Maybe, maybe not. This is where being in a duplex scenario it's not great. Is it going to work 100% in every location? No, of course not. You have to be careful. What location you buy, what product you buy, what unit mix, what unit layout, size, all of that matters. It's crucial. And understand, when we buy an asset and we go into a location, there's no comps. Nobody's done it before. And so it's a real gut check. So I'm not saying, it's a walk in the park like it's simple. Yeah. No, we're taking on a lot of risk. We're reaping a lot of reward for it, but we're taking on a lot of risk. But the whole business profile was, listen, if we fund this renovation while the times are good, then we're guaranteed, and COVID was an example. Most sponsors have one pile of money. Here it is. Yep. When the times are good, we're going to spend some of that money on capital improvements and make the units nicer. But if the times are bad, there's risk in the marketplace. COVID happened, Black Swan. Let's shut that off and hold reserves. Well, we don't do that. We have a pile of money here for CapEx. Yep. And another pile of money here for reserves. So when COVID happened, guess what? And we're vertically integrated, so we own our construction company in-house. So we continued renovating units. Full steam. Yeah. Every unit that came up, we renovated every unit throughout the entire COVID thing. So while everybody else took 9 months and lost time, essentially, we continued to renovate the whole thing. And so now we're ahead of the game relative to where other people are in the best market in the country.
All right, so let's dig into some of this. I'm realizing this could be a 5-hour podcast, but we can't do that. So let's hit some stuff that I know people think about when they start hearing these conversations, because you're talking about some of the operational and the tactician stuff.
Yeah.
Let's go back to maybe more of a this is going to be, it really depends, and I know it's going to be a deep answer, but how are you finding properties? I know you're in Phoenix. I assume you're staying in that Phoenix area. How are you finding these deals that you're getting? Very
simple. All of it is brokers.
Really? Okay. All brokers.
All of it is brokers.
Okay. Is there a plethora of deals, or are you like, is this a real grind with relationships and working grind. It? Okay.
It's a real grind. It's a real relationship thing. Mm-hmm. And the deals are extraordinarily hard to come by. Most of our stuff comes to us off market. We can't be competitive on market.
Okay.
Last time we tried to offer on a property that was on full market, there were 50 offers from all over the country, and the property ended up trading $5 million more or something like that than what the initial broker guidance was. So we typically, we've bought on market, but it's been a couple of years. We haven't been able to.
So you're dealing with brokers, and you're saying you're buying off market because once it hits the market, it's a feeding frenzy and it goes for too much.
So what I mean by market in this institutional space, market is when they hit the send button and it goes out to 70,000 email boxes.
Gotcha. So here's my question. I'm sitting out there listening to this conversation, and maybe I'm a broker, and I say, why would any broker worth a damn go to Ben and let him buy this when he knows for a fact if he hits that send button, he'll get way more money for that property?
Well, because not every seller wants to go to market.
Okay.
I've got a property in contract to sell right now to another syndicator who wants to, finish out the project.
Yeah.
That we took the revenue from about 120 to about 160, 165 in the last 18 months. We've built the gym, we've built the office. We actually do ground up. We do serious construction, serious lifts.
Yeah.
Renovated about 50% of the units. But a broker in town who knows we have the property, they had somebody looking. He thought this property would fit the bill. He called me, said, can you shoot me the financials? Looked at it, and we had an offer.
Yeah.
It's done like that.
Okay.
There's an extreme shortage of product. And he knows I'm going to have to roll the money into something else. So there's a lot of brokers in town that are hopefully currently searching for property for us.
Yeah.
But as a seller, I don't necessarily want to go to full market specifically. Now, if this is a turnkey asset that I've fully renovated, then that goes to selling in different stages of the cycle of our ownership of the property.
Yeah.
It's a separate conversation, which I guess we need to have in order to really peg all of this on. But as I mentioned, we sit there and we try to identify the buyer profile that would work for a property. So a syndicator who is perhaps doesn't have a construction in-house, or who's perhaps more in tune with, instead of renovating 100% of the units, they will have platinum level right here, and that's going to be our renovations. And then they will have gold level here, where they will do lipstick on the pig over here. And then they'll have silver over there that they will barely touch, maybe replace the flooring or what have you, and just keep the classic. A lot of people operate that way, but it's a de-risked deal, and that's what they want. They don't want to do the heavy lift, but we've done it for them, and they're happy to pay us for it. But they're more comfortable with another kind of business profile. So
gotcha.
They walk into our transaction. So that's one kind of, then as a property evolves and now it becomes a turnkey. Well, now if we own it for 5 years after it's been made turnkey, now it's light value add all over again. So at every stage in the property cycle, it's a slightly different buyer profile that's interested in that.
Yeah, that's a great point, actually, Ben. You buy a property. Let's just say you don't sell it for whatever reason right away, and you have it for how many years and maybe you haven't gotten to this point yet, but if you were to hold on to a property, how long does it take before the process kind of needs to start again because of wear and tear?
Yeah, it's about 5 to 7 years.
Okay. Is your plan to not be involved in that deal beyond that, or are you totally open to that?
Yeah. I'm open to that, but my plan is to deliver the highest returns on a risk-adjusted basis.
Okay.
And, value add is the single mitigator of risk.
Gotcha.
Because I control the process, not the market. It's got nothing to do with the market. If I'm capitalized to complete the process, and I've raised the capital to complete that process on day one, I have the money to do it, irrelative of what's happening in the market.
Yeah.
And regardless what's happening in the market, having quality is always better than having a pig.
Yeah.
So I'm never going to not want to complete that process. But I'm always trying to get out. That's my job. I'm always trying to get out because having value of money on the internal revenue, rate of return basis, you're always better off to go sooner than later.
Yeah.
You're always better off to have some value add when you are selling because there's additional buyers that may be interested.
Yeah.
But you're prepared to stay there for a long time if need be, if you can't find an exit. But in order to find the exit, you got to be looking for that, and you got to position the property for that. And that's what we do. That's my job. That's
gotcha. Okay, so you have brokers that you deal with. It sounds like fairly exclusively. It's a relationship thing. It's a grind. It's very difficult to find deals. From a bullet point perspective, what are some of the things that you look for in a deal that a broker brings to you to determine whether or not it's something you're interested in pursuing and moving to the next step?
Well, for me, everything starts with safety and what that product is, where it is, what it looks like, the vintage, the mechanical setup. Those things are the things that are very difficult to change. Mm-hmm. You can't take a 70s, 60s, 70s construction, catwalk, hotel-looking thing and convert it into something that looks like it was built in 1990.
Yeah.
You just can't do it because the design features, it's not really even functional obsolescence. It can still be very functional, but it'll never, there's nothing, I can't spend enough money to make it look like something it's not.
Yeah.
So unless it's a very special location, which is a whole another conversation.
Sure.
In some locations, you just buy what you need to buy in order to be in that location.
Yeah.
That's all there is to it.
Yeah.
In majority of the cases, I just told you, location, vintage, type of mechanical setup, unit mix, unit size.
Okay.
Those 5 things, and right away I get the lead. I don't have to look at financials. If it doesn't look like the right kind of product for that, I'm not interested.
Vintage, you mean the year? Is there a cutoff for you?
I like 80s.
80s or newer, I assume. Mechanicals, what do you mean by that? Is there a certain kind of mechanicals you don't want?
Boilers and chillers.
Okay, boilers and what? I'm sorry.
Chillers.
Chillers.
Which out here in Arizona, they're prevalent. They don't really work well enough to sustain cool, comfortable environments in 115-degree weather. But that's what was available and what was installed in the 60s and 70s, in some cases in the 80s, all not often.
Okay.
But, unit layouts are important. And generally speaking, until you get into the 80s, it's touch and go. Okay. We've bought 60s product before, but it was a special location kind of thing.
Okay.
Where we just have to have the product.
Yeah.
And we did what we needed to do. I mean, and continue doing it because we still have that in our portfolio.
What's wrong with 60s layouts? What are they non-functional? You said they could be functional, but what is the problem with them? What's the major problem?
A lot of times 60s layout is more mechanical rather than layout wise.
Okay.
And also very region specific. If you look in the Midwest, there's nothing wrong with the 60s.
Yeah.
If you look at Arizona, 60s is it's old.
Yeah.
But Arizona, Phoenix, has added 100,000 population in 1 year last year. It's a 5 million MSA today. And a decade ago, 50% of the freeways didn't exist in this town. This is a very new town. That's why 60s construction here and 60s construction in Indianapolis are not equivalent conversation.
Gotcha. Okay. That's good. That's a good distinction, because I'm thinking in Michigan, 60s, it's not horrible. It's not that big of a deal necessarily. So it's interesting to know. All right. So the big thing I think people have when they start thinking about big multifamily is they go, I understand everything Ben's saying philosophically, at least they understand it conceptually, but you're talking about millions and millions of dollars. So you go from like a duplex that you might be able to finance traditionally, or have a private lender that has $100,000 if you're in the Midwest and they can help you finance that. How are you financing these multi-million dollar deals? I mean, I think I know, but let's just help people who are wondering how you do that.
They're all syndications. These are all private placements.
Yep.
Whether it be a B or a C, accredited only or not. I mean, it's private placements.
So how are you finding these investors? What's the mode here? What's the plan? Private network? I mean, that's a B, right? But how are you? Are you
private network? It's all private network because we've never advertised. It's all. I mean, I've been around for a long time. I've written on BiggerPockets for a decade.
Yeah.
I have a lot of students that I taught back in the day. You're talking about thousands of students that I taught back in the day. I am what they call a known commodity, which is why facetiously we started the podcast the way we did. Like, if you don't know Ben Leybovich, what the fuck is wrong with you? I mean, if you're 18 years old and you're listening to this podcast, 10 years ago, you're still sucking on your mama's titty. So that's okay. You're excused not knowing.
Yeah. I miss having you on, Ben. It's been a while. I forgot what it's like to have you on as a guest. Okay, understood.
I'm making him blush.
No.
Right,
listen, I've my dad was a Marine, and I had all boys in my family. Trust me, I've heard it all. But
you know what I'm saying?
Yeah, I know exactly. So, okay. You're a known commodity. That's a relatively unique situation. However, it does bring up a greater point of don't try to be anonymous in this industry. Don't think that you can operate under a rock and never talk about anything. The more connections you make, the more relationships, the more you become a known commodity, or at least someone who's reliable and has been around and knows what they're talking about. So that means Ben, 15 years ago, may not have had the same opportunities to raise money as Ben 2021, because you are a known commodity and you've spent that time and that time equity building up who you are, what's your name, and the fact that you have some knowledge here and that people can trust you.
Right. And it gets easier once you start performing. First, you start performing for private investor here and there. Then you start performing for a small partnership. Then you start performing with, delivering huge returns on your exits on, so it does help. But let me take you back to another point. It's not that I spent 15 years trying to be known.
Sure.
It's somewhere down the line, I realized that being helpful is the best way to be known.
Yeah.
And that's the way that produces the most positive, what's the goodwill, in the space.
Yeah.
So I realized as an entrepreneur, it's very simple, you guys. It's a very simple formula. If I want to know something, I bet you there's a bunch of people who want to know the same thing about the same stuff for the same reasons that I want to know about it. So if I figure something out, why don't I write it down?
Yeah.
Why don't I do a podcast about it? Why don't I create a course about it?
Yeah.
We talked about CFFU. We talked about the house hacking. I didn't write about house hacking because I figured I did it. And it completely filled a gap in my financial universe at that stage, at that point in time. I showed up to a new city and I did research and tried to figure out what to do. And this was an answer. And I said, well, shit, this would be a great answer for a lot of people in my position. And there's a lot of people in my position.
Mm-hmm. Yeah.
So I wrote a book about it, did a couple of podcasts about it, right? The same is true with syndication, the podcast, the Syndication Not Scripted. Multifamily. I don't know what my shit is called.
I know. I'm already looking it up for you, Ben, just so I can make sure. Multifamily Syndication Unscripted. There you go.
Yeah. So we just recorded another season, about to release it in the next month or so. But the same idea. You provide content without the BS that is real, it's actionable, it's helpful to someone. Now, would I create another CFFU course about single family, small multifamily? No. My time is worth too much. I am not in the business of making money on education. There's a lot of people out there in the business of making money on education.
Yeah.
I make a lot of money doing what I do. So I am happy to help, but I don't charge for it. I don't make money on education. That's not my thing today. Okay.
Yep.
But I still do it because that's the thing that develops the goodwill. And that's the thing that as I learn, you learn. So every season of the podcast that we release is because we learned a bunch of shit in the last year, and it's all in this podcast. So that's why we release it. Now, do you think people do a double take and say, wow, first of all, these guys are doing something. And second of all, they're actually talking about the actual stuff that they're doing without charging $50,000. I mean, of course they do. Do you think it attracts people to Ben or Sam or WhiteHaven Capital or what? Of course it does. But the whole premise that underlines everything in entrepreneurship is that you are filling a knowledge gap for somebody. And the more people you fill that knowledge gap for, the more payoff you're going to see in the end. And you can't tell right away what kind of payoff it's going to be, like what it's going to look like. Yeah. Sometimes they give you a couple of $100 for the course, which is fantastic. Other times they give you a couple of $100,000 to put in your deal, which is fantastic.
Yep.
So,
Yep. So the big point here is, guys, not to imply that Ben 10 years ago set out to become a known person so that he could get money. The point is providing value, putting value out to the world, and helping people eventually just sort of caught up with you and became a benefit to you and your business because you've been helping people for a decade or more, and that's what you're talking about. And I think that's important because if you say, well, Ben said, or Mike said, that Ben said, I need to go out there and start making a name for myself, and then I can expect people to give me money. That you're missing the point, right? Ben was putting out things on BiggerPockets. Yeah.
They're not stupid.
Yeah.
They can read my stuff and read somebody else's and know that they should be talking to me. They can, the people aren't stupid. You're not going to fool people, or at least you're not going to fool them for a long period of time,
right,
and have a long, illustrious career staying in this business. People aren't stupid. Yeah. And if that's not enough, you are going to have to stand in front of the pearly gates at some point, and you have to answer for what you did. So don't be a shithead.
Yeah.
And teach people that which you don't know, or take some kind of shortcut or whatever.
True.
Yeah. Every step of the way, I was very passionate about what I was doing, and like the thing is, the reason I wouldn't teach right now is because I just don't have that passion. It wouldn't be fair for me to continue doing it. CFFU, I created, 8 years ago. And it's automated, and people still buy it. And God bless, it's $200. It's the best value. It's well organized. You can go ahead and go log on to BiggerPockets and spend the next 5 months trying to find your ass from your head. You can do it if you've got the time.
Yeah.
Or if you don't have the time, you can pay $200 and buy Ben's, thing. And it's just great, but there's nothing new in it. There's nothing, $200 is fair, and it's automated.
Yep.
And it's there for people.
Yep.
Who wants it? Great. Fantastic. It's not my business.
What's it called again? Remind everybody what's, in case they're curious.
Cashflow Freedom University. It's on my website, justaskbenwhy.com.
Okay. Got it. Justaskbenwhy.com. Yep.
That website, our syndication website is WhiteHavenCapital.com. And that's myself and my partner, Sam, and all of that ecosystem.
Okay.
So I've moved away from Just Ask Ben Why.
Yep. And we'll have all this in the show notes, guys. So don't pull over your car or whatever. Just we'll have it in the show notes. Go check it out. I told you we'd be done within the hour, and I should have known that you're an interesting guy. You have a lot to say. We could do this for another hour easily. I've got notes that I haven't even gotten to, but I do want to ask you this because I think it's on people's mind. What in your world? Forget about single family for a minute. Just talking your world. Right? We're in syndication world. What, if any, effect can we expect to see, or what do you expect to see yourself in your own business from this whole COVID pandemic? What do you think will be the result over the next 18 months or 24 months from COVID?
So I don't really care. A, all of my projects are capitalized.
Okay.
B, I'm prepared to hold for a decade if I need to. C, if times are good, I'm selling and making a bunch of money. If times are bad, I'm buying at a discount and making a bunch of money.
Right.
I don't really care.
So honestly, that doesn't sound that different from an answer if you were going to answer about more of a single family kind of a world. And I tell people the same thing. I appreciate this because you kind of said it in our last interview too, when I asked you not about COVID, obviously, but the market. And you said the market doesn't matter. It's knowing what's happening and being able to react to that. So when the market's down, you should be buying. When the market's up, you should be selling. It's very straightforward. But I think people ask me all the time, how's the market? And I go, it's great. And it'll be great in 5 years, it'll be great in 10 years, it'll be great in 3 months. It's always great if you're paying attention to it.
Perspective on what is great changes.
Yeah.
But your ability to make moves doesn't change as long as you have enough knowledge about this business and this art form that we call real estate.
Yeah.
I'm being a little facetious and I don't care because I want a strong economy because I love America. I was born in socialist Russia. I love America as much as I love anything else. I don't want a depression. Right. I don't even want a recession. I mean, I hope it stays strong forever. Of course, that's not realistic.
Yeah.
Because
well, the point is, though, the market isn't good or bad. The market doesn't have good and bad. It just
cycles.
It is what it is. Yeah,
the market cycles.
Yeah, it just cycles.
And you have to know, and this is not very different from playing a game of chess or a game of golf or anything. There's a cycle to everything.
Yeah.
The point is what most people don't understand. The best offense is defense, and the best defense is offense. So if your business model is built on both, not one or the other, both, then you can operate.
Yeah, agreed. I love it.
And the thing is, even if the market is high, listen, when somebody's always complaining. When there's discounts in the market, the money is tight because the lenders are tight. Because the economy is cycling down. So it's difficult to get things financed. So we're complaining about that. When the market's high, you can get cheap money all day long. I can get, 2.8% 10-year paper from Freddie Mac.
Yeah.
That's, might as well be free, right?
Yep.
But the deals are high.
Yeah.
But can you wrap your head around how to make those deals work in spite of them being high? And then on the bottom side of it, who's going to give you a call if you are waiting for the deals, for the market to cycle? We don't know when it's going to happen. When it does happen, who's going to get a call? Me or Mike or you? You're sitting on the sidelines waiting for that to happen. Good luck getting that call.
Yeah.
Mike and I are still going to clean up.
Yeah.
Because why? Because we're a known commodity. We have the relationship. We have the expertise. We have the operational knowledge.
Yep.
And so when it comes to raising capital and when it comes to getting a loan from Freddie Mac, guess who is getting that money? You or me?
Yeah.
At the end of the day.
Yep.
And so I don't, it's good or really good. I don't buy into this idea that you can only time buying.
Yeah.
To a certain time in the cycle. You can't buy the same way. You can't buy the same product. You can't, but that kind of evolution that we started the podcast with, you look at yourself in the mirror.
Yep.
That evolution never stops. Those pivots never stop. It's like a ladder. You climb a step, you catch your balance, and after a while, you realize that you're losing that balance because the step is pulling away or going sideways. Now you got to go to the next step.
Yep.
That evolutionary process never, ever ends. That's what they call professionalism in real estate investing. You got to be able to learn and pivot, make changes.
Yep.
But if you understand this, then you understand that cyclicity doesn't have anything definitive to say about you playing the game.
Yeah. I agree, man. I love it. Well said. I don't think I can improve upon that. Listen, we've hit the hour. I'm going to let you go, but I really appreciate your time. I know you don't use it so much, but just in case people are interested in that cash flow, that program, just askbenwhy.com. Otherwise, is it WhiteHavenCapital.com? WhiteHavenCapital.com. Go there and check out what Ben's up to. If you like what he has to talk about, go check out what he's doing, and perhaps maybe it makes sense for you at some point to reach out to him about being involved in his syndications. Ben, as always, man, I appreciate your time. I appreciate your expertise. And more importantly, all kidding aside, I appreciate your candor and your straightforwardness, because sometimes it's difficult. I'm not going to name names, but not everyone has this just honesty. Sometimes it's very packaged and it's positioned in a certain way because they're trying to, you just say it, man. And I like that. So thanks for that.
It's my pleasure.
All right,
Thank
man.
you.
Well, we won't wait 7 years for the next time. Hopefully we can do this again sooner. But again, thanks for your time. All the luck in the world to you. I know you're good at what you do, but luck never hurts. So good luck in everything you do. All right, man. Good luck to you. Stay safe.
Thank you.
Bye-bye. Okay. I told you, Ben's a straight shooter. He comes at it from a position of just honesty, right? And sometimes that includes a few choice words, but I think we can handle it. I enjoy interviewing Ben. I enjoy talking to Ben. He's a fun guy. He's a smart guy, and he just, like I said, he's a straight shooter. But he's seen a lot. He's done a lot, and I just know from knowing him over the years that he's a conservative investor. He's not out there taking wild risks without any when he tells you something, you can absolutely take it to the bank because he does his due diligence. He has studied the game. He knows what he's talking about. And I like those kind of people. It's interesting and fun for me to have a chance to get into the mind of someone who is very meticulous in his research, very, very knowledgeable about what he talks about. And Ben has had an evolution over the years of going from single family to duplex, fourplex, small multifamily, and now larger syndications. And to the point that he's uprooted his family, moved to Arizona, and because he did it strategically to make sure that everything was aligned to make sure that he was successful and his family had the best chance for success in life. So love it. I applaud the guy. I enjoy interviewing him. I hope you guys got a lot out of that. It was a little higher level discussion. It was a little more advanced, which is great because if you're not there yet, you get to hear it. And if you're there now, this was very actionable for you. So I hope you enjoyed that. But guys, get out there and get started. Ben didn't do this overnight. This is not an overnight thing that he is where he is. He started small, built himself up, and he did what he needed to do at the moment and the time he was in, built that business until he was able to move on to the next step. And that's what it's all about. But it doesn't work until you get out there. Stop sitting on the sidelines, stop thinking, and start doing. Okay, guys, we'll see you next time. Okay, you're still there. You're still listening. That's awesome. And I really appreciate that. Now, hopefully it wasn't an accident. Hopefully you didn't leave the room and I'm just talking to an empty room right now. But assuming you're still there, I want to do something really, really cool for you. For a limited time, I want to give you a free digital download of my book, the entire book, Level Jumping. If you're a listener to the show, you know it just came out and it really details how I took my business from being like one where I was just doing a few deals a month, maybe 1 or 2 deals a month, to doing over 10 and sometimes 15 deals a month and over 100 a year. And I went from doing very little profit to over $1 million in profit. And I made that transformation in a 12-month period. And this book talks about what I did, the steps I took to transform my business and how you can too. So grab a free digital download and you can get that by texting the words "just start" as 2 words now, "just start" to the number 55444. So text "just start" to 55444. I will send you a free digital download of my book. It's the complete book. There's nothing held back, and that'll be completely yours just for making it to the end of the show and listening to me. And I really, really appreciate it, guys. So I want to do something nice for you. I do this every once in a while at the end of shows, and if you listen to the very end, every once in a while, I do a giveaway like this. So hopefully you enjoy that. Go grab a free copy. I hope you read it. I hope you love it. Reach out. Let me know what you think. All right, guys. Talk to you next time.